When most people say the word crypto, they effectively use it as a synonym for just one thing: Bitcoin. Treating the entire ecosystem as a single asset class leads to a specific financial danger. Investors apply a buy and hold strategy to assets that were never engineered for long-term storage. This chart maps the reality of the landscape, using price volatility on the x-axis and decentralization on the y-axis. The ecosystem actually consists of 10 distinct categories, and as you can see, they are scattered across the quadrants based on their structural design. The central trade-off is consistent. Opting for price stability or practical utility requires moving away from speculative upside and absolute decentralization. To avoid an unpredictable portfolio collapse, the underlying technology must match your specific financial goal. Bitcoin and Ethereum serve as the foundational pillars of the space, but they operate with entirely different objectives. Bitcoin relies on a mathematically hard-capped supply of exactly 21 million coins, managed by a public ledger that functions without government oversight. This scarcity allows it to function as a long-term store of value, digital gold, though investors must endure heavy short-term price swings to realize that value. Ethereum, launched in 2015 by Vitalik Buterin and a small group of developers, moved the focus away from currency toward programmable infrastructure. The core innovation here is the smart contract, self-executing pieces of code that carry out agreements automatically, removing the need for a middleman. While this grants the utility to build complex applications, users must pay fluctuating, unpredictable network fees for the computing power required to run them. Due to these fees and inherent volatility, neither of these foundational assets is practically suited for everyday micro-retail transactions. Beyond the two giants lies a secondary layer of assets designed to support specific platforms or offer alternative networks. Utility tokens grant specific perks within a platform. Binance Coin, for example, originally served to provide discounted trading fees for its users. Governance tokens, such as those used by Uniswap, give holders active voting rights on the funding and policy decisions of a decentralized platform. Altcoins act as alternative competitor networks, often altering the original blockchain formula to prioritize metrics like privacy or transaction speed. The trade-off for these tokens is a lack of independence. The token's value is locked to the survival and popularity of that one specific startup. These assets provide operational access or influence within a digital ecosystem, rather than serving as general-purpose money. Bridging the gap between blockchain technology and traditional markets required assets that do not fluctuate in price. Stablecoins solve this by pinning their value to a stable asset, like the US dollar, and backing the circulation with matching reserves. This enables fast, frictionless cross-border transfers, though users forfeit any chance of the asset increasing in value. Security tokens take this further, representing fractional ownership in regulated real-world assets like real estate or company shares. On the governmental side, central bank digital currencies, or CBDCs, are digital versions of national money aimed at modernizing payment systems. Countries such as China have already moved into active pilot programs for these centralized currencies. The CBDC trade-off is structural. Users gain rapid settlement speeds, but surrender the financial privacy and decentralization that defined the early crypto movement. Achieving price predictability and regulatory approval requires reintroducing the centralized control the technology was initially built to bypass. We turn now to assets driven by internet culture, community sentiment, and digital collectability. Non-Fungible tokens, or NFTs, act as unique proofs of ownership. Because no two are identical, they cannot be used as a standard currency. Meme coins often start as jokes, but they can attract massive trading volume driven by social media attention rather than technological utility. The trade-off here is extreme. While there is potential for massive short-term spikes, these assets frequently crash to zero just as quickly. These assets function as high-risk entertainment, not as viable pillars for preserving wealth. Choosing the right asset begins by defining the specific function you need this technology to perform. If your objective is long-term scarcity and wealth preservation, the path routes to Bitcoin. If you need to move money across borders with a predictable value, the logic leads to stablecoins. For those interested in fractional ownership or building applications, the framework splits into Ethereum, governance, and security tokens. Finally, those seeking high-risk speculation land in the category reserved for meme coins and NFTs. Using this functional taxonomy eliminates the risks of monolithic thinking, allowing for strategic, goal-oriented financial decisions.